October 24, 1929, Black Thursday. The New York Stock Exchange floor roared like a dying animal. 12 million shares traded hands that day, triple the normal volume, and every single one represented someone's dream turning to ash. The noise was deafening. Men in suits shouting themselves hoarse, brokers screaming orders they couldn't even hear over the chaos, ticker tape spilling from machines like entrails, the paper piling up faster than runners could clear it away. And in the middle of all that panic, there was silence in the eyes. You could see it if you looked close enough. The crushing weight of realization hitting all at once, life savings evaporating in real time. Let me tell you about one of them, a school teacher from Brooklyn. We'll call him Thomas, though his name doesn't really matter because he could be anyone. Thomas had been careful his whole life, saved every month, never spent recklessly. When his broker, a well-dressed man with a confident smile, told him the market was a sure thing, Thomas believed him. Why wouldn't he? Everyone was getting rich. The newspaper said so. The radio program said so. Even his neighbors, people he'd known for years, were buying stocks on margin and doubling their money in weeks. So Thomas took $3,200, 20 years of teaching children mathematics, 20 years of modest living and disciplined saving. He put it all into the market in the spring of 1929, borrowing another $28,800 on margin, like his broker recommended. By September, his portfolio was worth $47,000. He was going to retire early, buy a house upstate, maybe travel to Europe like he'd always dreamed. By noon on October 24th, it was gone. All of it. The margin calls came so fast he couldn't even process what was happening. His broker sold everything to cover the debt, and Thomas still owed $11,000 he didn't have. 2 decades of work, erased in 4 hours. He stood outside the exchange that afternoon, watching men stumble out onto Broad Street with their faces blank, and Thomas understood with perfect clarity that his life would never be the same. But here's what they don't tell you in history class. Here's the part that gets conveniently left out of every textbook and documentary about the Great Depression. While Thomas and millions like him were being destroyed, something else was happening in the shadows. Certain people were walking away, not running in panic, walking, calmly, deliberately, with their wealth not just intact, but positioned to multiply in the ruins to come. Joseph Kennedy, who'd later become the patriarch of America's most famous political dynasty, had converted his entire portfolio to cash and gold by early September. Bernard Barish, one of the wealthiest men in America, was completely out of the market by August. The Rockefellers, the Morgans, the Mellons, all of them had quietly repositioned in the months before the crash. They didn't just survive, they profited. Massively. And if you think that was just good timing, just lucky instincts, just coincidence, then you haven't been paying attention to how this game actually works. Because here's the thing that should keep you up at night. The thing that connects 1929 to right now, to your 401k, to your retirement account, to every dollar you think you've safely tucked away for the future. Those men didn't get lucky. They knew. They knew because they helped design what was coming. They understood the mechanism, the trap, the extraction. And if you think that was just history, if you think that kind of coordinated wealth transfer was something that happened once in a moment of chaos and could never happen again, look at your bank account right now. Look at your retirement fund. Look at where your money actually is. The same trap has been reset, upgraded, digitized, made faster and more efficient and infinitely harder to escape. What if I told you the crash wasn't an accident? What if I told you it was an extraction? A planned transfer of wealth from millions of ordinary people to a small group of insiders who understood exactly what was coming because they engineered it. And what if I told you they're doing it right now, and this time you won't even be able to run? Let me ask you something. Where's your money right now? Not conceptually, not in some abstract sense. Where is it actually located? Your retirement account, your 401k, that number on the screen that you check maybe once a month telling yourself you're being responsible, you're planning for the future, you're doing everything right. That number represents maybe $50,000, maybe $150,000, maybe more if you've been diligent for decades. You've been told this is smart, diversification, long-term thinking, dollar-cost averaging, time in the market beats timing the market. All the mantras your financial advisor repeats like gospel. But here's what nobody's telling you. That money isn't actually yours, not in any meaningful sense. Oh, legally it's yours. Your name is on the account, but try to access it right now, today. Try to pull it out. You can't. I mean, technically you can, but you'll pay a 10% early withdrawal penalty if you're under 59 and a half, plus federal income tax at your current rate, maybe 22%, maybe 32%, depending on your bracket, plus state income tax. By the time you actually get your hands on that money, you're looking at losing 35 to 45% of it before you see a cent. But the penalties are just the first lock. Here's the second one, and this is the one that should terrify you. Time. When you submit that withdrawal request, it doesn't happen instantly. It enters a processing queue. 7 to 10 business days under normal conditions. But normal conditions are about to become very abnormal. And when everyone tries to withdraw at once, when panic hits, and millions of people realize simultaneously that they need to get out, those systems slow down or freeze entirely. It's not a glitch. It's not an accident. It's deliberate design. The same mechanism that trapped your great-grandparents' wealth in 1929 has been upgraded, digitized, and redeployed to trap yours. They learned from that crash, not how to prevent crashes, how to prevent you from escaping them. Think about it. In 1929, if you sensed danger, you could walk into your bank, present your passbook, and withdraw everything in cash. Same day, that afternoon. No processing periods, no approval workflows, no suspicious activity reviews. Your money was actually accessible. Today, you're sitting inside a burning building and you've been told to choose between two doors, the 401k door or the taxable account door, the stock market door or the bond market door, the mutual fund door or the ETF door. And while you're carefully weighing which door to choose, following the advice of experts who assure you one of these options is the smart play, the real exit is hidden behind a curtain that only the architects can see. The people who designed this system. The people who know when to walk away before the building burns. Here's the kicker. Every piece of financial advice you've ever received, every rule you've been told to follow, was created after 1929, specifically to keep your money trapped inside the system when crisis hits. Why do you think every financial advisor gives the same advice? Stay invested. Don't try to time the market. Ride out the volatility. Keep contributing through the downturns. It's not because that strategy protects you, it's because it protects the system from you making the rational decision to save yourself when disaster approaches. This is what Wall Street doesn't want you to understand, the liquidity game. Your retirement account isn't a safe deposit box. It's a pool of capital that financial institutions use, lend out, leverage, and profit from. And when that pool starts draining because people want their money back, the whole machine breaks down. So they built gates, penalty walls, time delays, legal restrictions, all designed to keep the pool full when everyone realizes they need to get out. And it's not just retirement accounts, your checking account, your savings account, your brokerage account. Every single place your money lives has restrictions on access that activate during crisis. Try withdrawing $10,000 in cash from your bank. Just try it. See what happens. Federal law requires them to file a currency transaction report. The bank has discretion to delay your request for a suspicious activity review. And even if they approve it, your daily ATM limit is probably $500. So to get your own $10,000 out of your own account, you'd need 20 separate transactions over 20 days. The crisis would be over before you could extract your own funds. This isn't conspiracy theory. This is documented policy. Rules created by regulators, embedded in every financial institution, sitting there dormant until the moment everyone tries to use the exit simultaneously. You're not invested in the market, you're trapped in it. And unlike 1929, when the trap was invisible and people just didn't see it coming, this trap is visible. It's in the fine print of every account you have. It's in the terms and conditions you clicked through without reading. It's in the fee schedules and penalty withdrawal policies and penalty structures. They're not even hiding it anymore. The mechanism they used in 1929 worked so perfectly, transferred so much wealth so efficiently that they didn't abandon it. They upgraded it. They made it legal, regulatory, official policy designed to maintain market stability and protect investors. But who are they really protecting? You or themselves? You stand to lose everything you've saved, your retirement security, your children's inheritance, your autonomy. Not because you made bad investment choices, but because when the trap springs, you won't be able to move fast enough to escape. It's called liquidity extraction. And it's happened at least 7 times in the last century: 1929, 1987, 2000, 2008. And it's about to happen again. But this time, they've learned. This time, the exits are sealed before the fire even starts. Let me show you exactly how the mechanism works, how they set it in 1929, how it extracted trillions, and how you're living inside the upgraded version right now, whether you realize it or not. If you want to understand what's coming, you need to understand what already happened. Not the story you learned in school, the real story, the one with names, dates, and mechanisms. The documented blueprint that they've used over and over because it works every single time. The 1929 crash wasn't a random market panic. It was a 3-phase operation: setup, trigger, extraction. And every single phase was engineered. Let me walk you through it. Phase 1, the setup. It started in 1924. That's when the Federal Reserve began flooding the system with cheap credit. They dropped the discount rate to 3%, then to 2.5%. Money became almost free to borrow. And this wasn't a secret. It was explicit policy, pushed by Benjamin Strong, the governor of the Federal Reserve Bank of New York. Why? The official story was to help Britain return to the gold standard. The real reason was to inflate asset prices and get ordinary Americans addicted to debt. And it worked beautifully. Between 1924 and 1929, margin lending exploded. You could buy $1,000 worth of stock for just $100 down, borrowing the other $900 from your broker at low interest rates. 10-to-1 leverage. And everyone was doing this. Not just wealthy speculators, school teachers, factory workers, secretaries, regular people who'd never invested before in their lives. How did they know to do this? Because they were told to. Radio shows talked about stock market success stories every night. Newspapers ran articles about ordinary people retiring early from investment gains. And a new financial product was created specifically to pull in the masses. Investment trusts. Sound familiar? It should. They were the 1920s version of index funds. You didn't need to know anything about stocks. Just hand your money to professional managers who'd invest it in a diversified portfolio. Safe, simple, smart. By 1929, there were over 750 investment trusts managing billions of dollars of ordinary people's money, money that was about to evaporate. But here's what makes this interesting. While everyone else was piling in, certain people were getting out. Joseph Kennedy started liquidating his positions in early 1929. He later admitted he knew the market was overheated when his shoeshine boy started giving him stock tips. Bernard Baruch was completely out by August. The records show he converted everything to cash and gold, then moved significant portions offshore. The Rockefeller family? Same thing. The Morgan banking interests? Same thing. And here's the critical detail. These weren't just wealthy individuals making independent decisions. Many of them sat on Federal Reserve boards. They attended private meetings where economic policy was discussed. They had access to information ordinary investors would never see. They knew what was coming because they were part of designing it. Phase 2. The trigger. In August 1928, everything changed. The Federal Reserve started tightening. They raised the discount rate from 3.5% to 5%, then to 6% by August 1929. They restricted the money supply. They made borrowing expensive. Why? The official story was to cool down speculation. But think about the timing. They'd spent 4 years encouraging speculation, making credit cheap, flooding the system with liquidity. Millions of people had borrowed money to buy stocks based on that cheap credit, and now, suddenly, the Fed was yanking it away. On August 8, 1929, the Federal Reserve raised the discount rate to 6%. That was the highest level in nearly a decade, and here's why that mattered. Remember all those people who'd bought stocks on margin? They'd borrowed at 3 or 4%. Now those loans were being called at 6, 8, sometimes 12%. The brokers who'd lent them money were suddenly facing their own margin pressures from the banks. So they did what the system forced them to do. They issued margin calls, demanded more cash from investors. And when those investors couldn't provide it because they'd already borrowed to the limit, the brokers sold their stocks to cover the loans, which pushed prices down, which triggered more margin calls, which forced more selling, which pushed prices further. It was a cascade. Deliberate, mathematical, unstoppable. And the ordinary investor, the school teacher with his $3,200 in savings leveraged into a $32,000 position, couldn't escape. He couldn't get information fast enough. The ticker tape was running hours behind actual trades. By the time he knew how far prices had fallen, they'd fallen further. By the time he tried to sell, everyone else was trying to sell. But certain people got out in time. Congressional testimony later revealed that in the months before the crash, insider trading was rampant. Executives sold their own company stock at peak prices while publicly expressing confidence. Banking families liquidated positions while their own institutions were still recommending buys to retail clients. This is documented, not conspiracy theory, documented in Federal Reserve archives, in congressional investigations, in private correspondence that's now public record. They knew, they got out, and they left everyone else holding the bag. Phase 3. The extraction. This is where it gets truly insidious, because the crash wasn't the end of the operation, it was the middle. By late 1929, stock prices had fallen 40%. By 1932, they'd fallen 89% from the peak. Entire fortunes had been wiped out. But here's what was happening in the shadows. The same men who'd exited in early 1929 came back with cash, with gold, and they started buying. Joseph Kennedy bought entire companies for pennies on the dollar. Real estate in Manhattan that had sold for millions in 1928 was available for tens of thousands in 1932. Kennedy bought it, the Rockefellers bought it, J.P. Morgan interests bought it. They purchased assets at 10 to 20 cents on the dollar, and when the economy eventually recovered, those assets appreciated back to full value, then beyond. The wealth didn't disappear in the 1929 crash, it transferred. From the middle class to the elite, from the many to the few. And the numbers are staggering. Between 1929 and 1933, wealth concentration in the top 1% increased by an estimated 37%. The top 0.1% saw even larger gains. Meanwhile, foreclosure rates hit 1,000 per day. 9,000 banks failed. 13 million people lost their jobs. But certain families emerged from the Depression wealthier than they'd entered it. Now, you might be thinking, okay, but that was one crash, one moment of chaos. That's not a pattern. Except it is. The panic of 1907 followed the exact same structure. Liquidity boom, encouraged speculation, sudden tightening, cascading failures, wealth consolidation. The 1920 to 21 depression, same pattern. The savings and loan crisis of the 1980s, same pattern. The 2008 financial crisis, same pattern. Setup, trigger, extraction. Every single time. The cover story. And every single time, the official narrative blames the victims. In 1929, they blamed greedy speculators for buying on margin. But who created the margin system? Who set the terms at 10% down? Who spent years encouraging ordinary people to use that leverage? The banks, the brokers, the Federal Reserve policymakers. But that's not what they teach in schools. In textbooks, the 1929 crash is explained as a psychological phenomenon, irrational exuberance, market madness, everyone getting caught up in a speculative frenzy. And there's truth to that. People did get caught up, but they were encouraged to get caught up, systematically, through policy, through media, through financial products designed specifically to pull them in. What they don't teach is the Fed's role, the timing of the tightening, the insider exits, the post-crash consolidation. They don't teach that Bernard Baruch, who'd been on the War Industries Board during World War I and had deep government connections, somehow knew to exit months before the crash. They don't teach that the Glass-Steagall Act, passed in 1933, supposedly to prevent future crashes, actually concentrated power in fewer, larger banks. The small regional banks failed. The big New York banks absorbed them. Crisis, rescue, centralization. That's the template, and it's been repeated so many times that anyone paying attention can see it coming. The 1929 blueprint isn't ancient history. It's the operational manual they're still using. And here's the thing that should terrify you. Every mechanism that made the 1929 extraction possible still exists. The Federal Reserve still controls liquidity. Margin lending still allows massive leverage. Investment trusts have been rebranded as ETFs and mutual funds, but they serve the same function, pulling ordinary people's money into the market where it can be extracted when the time is right. But they learned something from 1929. Some people escaped. Not many, but some. The businessman who withdrew his cash before the crash, the families who converted to gold early enough. The system allowed escapes, so they fixed that. They built the traps I described in the last chapter, the 401k penalties, the processing delays, the withdrawal restrictions. This time, when the extraction comes, you won't be able to run. The exits that saved people in 1929 have been systematically sealed. And if you think I'm exaggerating, if you think this sounds too coordinated, too deliberate, let me show you what's happening right now. The exact same pattern, playing out in real time, with the trap already set and the trigger finger hovering. The same three-phase pattern is visible right now. Setup, trigger, extraction. And if you know what to look for, you can see exactly where we are in the cycle. Phase 1, the setup. It started in 2008. The financial crisis hit, and the Federal Reserve responded by dropping interest rates to zero. Not 3%, not 2%, zero. And they didn't stop there. They launched quantitative easing, printing money to buy bonds, mortgages, anything to flood the system with liquidity. They expanded their balance sheet from $800 billion to $9 trillion. Free money for over a decade. And just like in the 1920s, ordinary people were encouraged to participate. Not through radio shows this time, through apps. Robinhood, Webull, trading platforms that made investing feel like a game. No fees, fractional shares, instant execution. Millions of people who'd never invested before downloaded these apps and started buying. Meme stocks, crypto, SPACs. It didn't matter what it was. Everything went up. And just like in the 1920s, new financial products were created to pull in more money. ETFs exploded in popularity. Passive index funds. Set it and forget it. Don't try to time the market. Just keep buying. By 2021, over $10 trillion was sitting in passive index funds. Regular people's retirement accounts, 401ks, IRAs, all feeding into these vehicles. Money that's now locked inside the system. And just like in the 1920s, while everyone else was piling in, certain people were positioning differently. In 2021, Jeff Bezos sold $10 billion of Amazon stock. Mark Zuckerberg sold billions in Meta. Elon Musk sold billions in Tesla. These weren't small portfolio adjustments. These were massive liquidations at peak prices. Were they just cashing out after years of success? Maybe. Or maybe they saw something coming. Phase 2, the trigger. In March 2022, the Federal Reserve started raising rates. Not slowly, aggressively. They went from 0% to 5.5% in 18 months, the fastest hiking cycle in 40 years. Sound familiar? It should be. Just like in 1929, they'd spent years encouraging borrowing and speculation with cheap money, and now they were yanking it away. And just like in 1929, the effects started showing up immediately. Regional banks started failing. Silicon Valley Bank collapsed in 36 hours. Signature Bank failed. First Republic failed. Commercial real estate started breaking. Office buildings in major cities that had been valued at hundreds of millions were suddenly worth a fraction of that. Loans tied to those properties started defaulting. The Treasury market, the $27 trillion foundation of global finance, started showing stress. Liquidity deteriorated. Bid-ask spreads widened. Large orders that used to move the market by a few basis points started creating 15 to 20 basis point swings. This is the illiquidity that precedes breakdowns. And what's the response? The same response as always. Stay calm. The economy is strong. Corporate earnings are solid. This is just temporary volatility. But while they're saying that publicly, look at what's happening privately. In the fourth quarter of 2024, corporate insiders sold $16.2 billion worth of their own company stock, 4 times the normal rate. CEOs, CFOs, board members, people who see the quarterly numbers before they're announced. They're selling at the fastest pace since 2021, right before that market peaked and started rolling over. Sovereign wealth funds are doing the same thing. Norway's government pension fund reduced equity allocation by 18% in 2024. Abu Dhabi Investment Authority increased gold holdings to levels not seen since 2008. These aren't retail investors panicking over a 5% pullback. These are institutions that manage trillions across decades. When they reposition this defensively, it's because their models show risks that justify sacrificing upside to protect capital.
Phase 3.
The extraction. We're not fully into this phase yet, but the positioning is visible. Private equity firms are sitting on record amounts of dry powder, over $2.5 trillion in cash waiting to be deployed. Why? Because they're waiting for asset prices to collapse so they can buy at the bottom, just like Joseph Kennedy in 1932. The big banks increased reserve ratios in 2024. They're holding more cash relative to loans than they have in 15 years. Why? Because they're preparing for defaults, for a wave of failures that will let them acquire smaller competitors, just like J.P. Morgan absorbing failing banks in 1933. The pattern is identical. The only difference is the tools are better, faster, more efficient. The modern mechanisms. Because here's what they've upgraded since 1929. ETFs and index funds are the new investment trusts. You're told they're safe because they're diversified, but that diversification is an illusion. The top 10 holdings in the S&P 500 represent over 30% of the index weight. Apple, Microsoft, Nvidia, Amazon. If those stocks fall, the whole index falls. You're not diversified. You're concentrated in the same mega-cap tech stocks everyone else is concentrated in. And when everyone tries to sell their index funds at once, what happens? The funds have to sell the underlying stocks to meet redemptions, which pushes those stocks down, which makes the index fall more, which triggers more redemptions. It's the same margin call cascade from 1929, just with different labels. Algorithmic trading has made it faster. In 1929, selling meant humans shouting orders on a trading floor. Today, 70% of volume comes from algorithms executing millions of trades per second. When volatility exceeds certain thresholds, these algorithms sell automatically, which trigger other algorithms to sell, which triggers more. We saw this in March 2020. The S&P 500 dropped 34% in 23 days, the fastest bear market in history. Circuit breakers halted trading multiple times, but those halts didn't stop the selling. They compressed it into smaller windows, creating more violent moves when trading resumed. Now imagine that with all the traps fully engaged. You're watching your 401k drop 30% in 2 weeks. You submit a withdrawal request. You're willing to pay the 40% penalty. Just get me out. But the request sits in processing. 7 to 10 business days under normal conditions, but these aren't normal conditions. Everyone's trying to withdraw simultaneously. While you wait, the market drops another 20%. By the time your request is approved, you've lost 50%. Then you pay 40% of what's left in penalties and taxes. Your $200,000 retirement account yields $60,000. That's assuming the withdrawal gets approved at all. Because here's what most people don't know. During peak crisis, plan administrators can invoke extraordinary circumstances clauses, suspend all distributions, for administrative review, for plan valuation uncertainty. It happened in 2008. Fidelity suspended certain 401k withdrawal requests for weeks. People logged in to find temporarily unavailable messages. Their money was there on screen, but they couldn't access it. Not because they lacked funds, but because the system includes gates that close during volatility. And while all this is happening, you'll be told the same things people were told in 1929. Don't panic. Stay the course. Time in the market beats timing the market. This is just a correction. If you sell now, you lock in losses. These mantras aren't designed to protect you. They're designed to keep you locked in while the extraction happens. Your financial advisor will tell you to hold. Meanwhile, the CEO of the company managing your mutual fund just sold $50 million of his own stock. The sovereign wealth funds are moving to cash. The private equity firms are waiting with billions to buy the assets you're forced to sell at the bottom. In 1929, they flooded the system with cheap credit, then yanked it away. In 2024, they did the same thing. Zero rates for a decade, then the fastest hiking cycle in 40 years. In 1929, they created investment trusts to pull ordinary people into the market. In 2024, they created ETFs and index funds for the same purpose. In 1929, insiders exited early while telling everyone else to stay invested. In 2024, they're doing it again. The insider selling data is public. The SEC filings are public. They're not even hiding it. It's all public information. The Fed meeting minutes, the insider trading disclosures, the bank reserve requirements. They're not even hiding it anymore. The trap isn't coming. It's already set. You're living inside it right now. And suddenly, it all makes sense, doesn't it? Setup, trigger, extraction. That's the pattern. That's the 1929 blueprint. And that's what's happening right now in 2025, playing out in real time with the trap mechanisms fully operational and the exits sealed. Here's the uncomfortable truth they don't want you to accept. The system isn't broken. It's working exactly as designed, and you weren't supposed to understand that. You have two paths from here. Path one is to do what the majority will do. Trust the system. Believe the reassurances. Keep contributing to accounts you can't access in crisis. Stay the course. Don't try to time the market. Follow the advice that every financial advisor gives because they're following a script written by the same institutions that profit when you stay locked in. Hope that this time really is different, that algorithms and artificial intelligence have somehow eliminated the business cycle, that central banks can prevent any real pain, that markets only go up if you hold long enough. That path is comfortable. It doesn't require you to question authority or think differently than everyone around you. You get to believe you're being responsible and prudent. And when the crash comes, when your retirement account drops 60% and you can't access what's left without devastating penalties, your loving have plenty of company. Millions of other people who followed the same advice, made the same assumptions, and lost the same wealth. There's comfort in shared suffering. Path 2 is harder. It requires you to acknowledge what you now know, that the pattern exists, that it's been used repeatedly, that the traps are real and embedded in every account you have. You can't unsee this pattern, and that's your advantage. Path 2 means operating with eyes open. It means understanding the liquidity cycle and recognizing where we are in it. It means questioning who benefits from the financial advice you're given. When your advisor tells you to stay fully invested while insider selling hits record highs, ask yourself why. It means studying how wealth was actually preserved during previous extractions, not what they teach in school, but what actually worked. The people who survived 1929 weren't the smartest or the most connected. They were the ones who recognized danger before the crowd did, who were willing to look paranoid while others celebrated, who understood that protecting capital matters more than chasing the last 20% of an overextended bubble. It means recognizing that the wealthy play a different game with different rules. They have access to private placements, hedge funds, offshore structures, and asset classes you'll never hear about on CNBC. And when they move to cash and gold while telling you to stay invested, that's information. That's signal through the noise. Here's what you can do. Not financial advice, just patterns to understand. Understand where you are in the liquidity cycle. We're in the tightening phase. Rates went from 0 to 5.5% in 18 months. That's the trigger mechanism activating. History says what comes next. Understand the penalty structure of your accounts. Know exactly how much you'd lose to access your money in crisis. Run the numbers. If your $150,000 retirement account would yield $90,000 after penalties and taxes, that's a 40% haircut. But if you wait and it drops 60%, then you pay penalties on what's left, you're looking at $50,000 total. Sometimes paying the penalty early is cheaper than paying it late on a smaller number. Understand that conventional advice exists to serve the system, not you. Don't try to time the market is great advice in normal times, but these aren't normal times. When insiders are selling at record pace while sovereign funds move to gold, that's not normal. Recognizing abnormal conditions and acting on them isn't timing the market, it's reading the obvious signals. Build accessible reserves outside retirement accounts. Yes, you lose tax advantages. Yes, you pay taxes now instead of later, but you gain something more valuable: optionality, the ability to move when you need to move. Remember the 1929 businessman who withdrew cash before the crash? He paid no penalties because his money was accessible. That accessibility saved him. Some people navigated 1929 successfully, not by luck, by understanding what was really happening, by recognizing the pattern, by acting before the crowd panicked. You can do the same, but the window is closing. Share this with someone who needs to hear it. The system relies on most people not understanding. Every person who recognizes the pattern is one less person trapped inside it. Knowledge spreads. Awareness spreads. And understand this is just one mechanism, one pattern. There are others. The history of finance is the history of wealth extraction cycles disguised as random market events. Once you see one pattern, you'll start seeing them everywhere. 1929 wasn't a warning from history, it was a blueprint for the future, your future. The traps are set, the warning signs are flashing. Insiders are quietly heading for exits while telling you to stay invested. The question isn't whether the crash is coming. The question is whether you'll be trying to escape through exits that no longer exist, trapped behind digital gates while your wealth evaporates, helpless, unable to act. In every transfer of wealth, there are those who understand what's happening and those who don't. Now you understand. The choice is yours. The timeline is closing.